Welcome to AllGen's Market Update. My name is Jason Martin, and today is August 26, 2020, and I got some topics we want to cover today. First of all, the U.S. stock market has hit an all-time high, along with coronavirus cases and deaths hitting some new short-term lows, so we're going to look at that. Big question we're getting right now, how does the market continue to go up? And we'll talk about where the money is flowing, and then where do we go from here? So let's hop right in. So this is looking at the cases, the daily confirmed cases. We get two lines here. One, this green line represents the world, and the red line represents the United States. So as you can see here, the world is broken into new 1-month lows, and then the United States is broken into 2-month lows in terms of cases. And in terms of daily deaths, you can see here the world has broken in and the United States has both gone into new 1-month lows. So that's encouraging on multiple fronts, but from the stock market standpoint, that's been a big driver of the market. You know, if the coronavirus cases and deaths have been getting worse, that's kind of been a negative to the market. As they've gotten better, that's been helpful for the market. So now, look, this is the S&P 500, just looking at the last 1 year, and specifically we're looking here at year-to-date and the rebound from the low. There's been, obviously there's a huge drop during the pandemic, a 35% drop, but then there's been an astronomical 54% return from the low. And then even year-to-date, the S&P 500 is up 6.7%. So, you know, I'm going to try to make the case here in terms of the question, how does the market continue to go up? So we're going to look at a number of charts to kind of show potentially why that is. And I've already made the case, one, that there's been some hope that coronavirus in terms of cases and deaths has been improving. The other one is there's a lot of optimism about a potential vaccine coming soon, and there has been some new treatment to come out, in fact this week, that has shown some statistical evidence of improving things too. So that's one reason that the market can continue to go up, but I think there's some bigger reasons out there. And one of those is this chart that I've been referring to quite a bit over the last few months, and this is a chart of the dollar. So the US dollar since 2008 has been on an upward trend. However, we've been mentioning in the last few updates that we believe that the dollar is starting to break down, and that's official now. If you look at this long-term trend line since 2011, this blue line here, we've broke down below that pretty significantly. And what that means is that the probability of the US dollar continuing to go down it is higher now, and potentially we're now entering into a downtrend in the US dollar. So what that means is, you know, if you think the stock market is high, and I'm trying to think and I'm trying to make the case for what the bigger money out there is thinking, what the institutional investors, the pension funds are thinking. If the dollar is trending down, would you put your money in cash to protect from a potential falling market? And some people are choosing or thinking that's a bad idea, because if you put your money in cash and the dollar is getting weaker, then you're losing purchasing power. You may not see the loss from a nominal standpoint, but from a real return, which factors in inflation, you're losing money. So then the thought process comes, okay, so if we don't want to hold cash, then where do we put our money? So you know, the other thing is out there, if you want to go a little bit more defensive, then potentially you hold bonds. The chart here that we're looking at is the 10-year Treasury yield. This is the chart of the yield. Remember, bond prices and bond yields are inversely related. So as the yield goes down, the price goes up. This is a long-term chart that goes back to 1981, and you can see this 40-year downtrend of yields. Well, now we are at, we pretty much hit zero. So if yields are at zero, then on the flip side, this is the Bloomberg Barclays U.S. Aggregate Bond Index, a measurement of bonds. Are bonds potentially at an all-time high, but are they potentially limited on the upside? We believe they are. And so if you're not going to go into cash, because the dollar could go down, do you go into bonds, which are at all-time highs and have limited upside? So then where does money flow? Because money's got to go somewhere, and there's a lot of money out there in the world. Where does it go? If it doesn't go in the dollar and it doesn't go into bonds, then where are some areas it can go? I already showed the S&P 500. It's at all-time highs. Money can go into stocks. Stocks can continue to go up in a weaker dollar environment. This chart that I'm looking at here, this is gold. This is something that we've been talking about. Gold is usually a good hedge against a falling dollar. So as the dollar gets weaker, gold tends to go up. This chart goes back 20 years, but you can see here over the last, from 2012 when it hit its prior all-time high, it was in a downtrend. It's broken out of that. In fact, that started last year. And then more recently, it's broken into an all-time high. So that's one area money can go to, not just gold, that's a big component, but also commodities. Commodities tend to do well as the dollar is getting weaker. Looking at here too, this is another potential area where money can flow into, and this is just a representation of the international markets, both developed international markets and emerging markets, using the Vanguard FTSE All World Index. Ex-US, which means that US stocks aren't in it. So there's a representation of international and emerging markets. This goes back 12 years to the high of 2007, and even to the beginning of 2007. This index is up only 2.5%. So you've gone 12 years, and that's been flat. At the same time, the U.S. stock market's up significantly, 200+% from that same time period. So, and at the same time, these stocks are domiciled in other countries and other currencies. So if the U.S. and the dollar's been going up from the majority of this time, and when the dollar goes up, international stocks usually don't do as well, especially if you're invested with U.S. dollars. But now going forward, if the U.S. dollar is potentially going down, then there is a lot more potential for international stocks to go up. And so you can have a scenario, and I think we're in one, where the bigger money is cautious to go into the dollar, the bigger money is cautious to go into bonds, and it needs to find a place to go that can do well over the long run. And you could certainly make the case that stocks could go up. Not all stocks. Some stocks are being hurt, but if you think about like consumer staples, stocks, there's some technology stocks. Some of those sectors have been doing well, even despite a slower economy. So instead of holding money into dollar or bonds, money's been flowing into those areas. You can also make a similar case, like I said, with international stocks. So all I have to say, while I tried to make a case because there's a lot of people that just are having a hard time believing why and how stocks are going higher. We do still believe stocks are very overvalued, especially U.S. stocks in the short term. And we think we're coming up into a potentially volatile time. Number one, you have the potential for a second wave of coronavirus, especially as schools start up as we go into the fall and winter months. So that's one thing that we think that can kind of derail this market. And then more from a short-term perspective, even though a lot of people think this is a major deal, and it is a major deal from the standpoint of the United States, but it's not a major deal. It's not the biggest driver of the stock market, and that's the elections. So we believe there can be some short-term volatility around the elections. However, as we've mentioned, and I'll continue to mention in future updates as we get closer to the elections, the bigger driver to the stock market is the debt cycle and the business cycle. And so it's not who's the president of the United States. So while we are prepared for elections and the potential for the market to get volatile during that time, we're trying to be more prepared for the potential of a second wave of the coronavirus, and at the same time, just the potential for a slowing and a difficult economy, and that stocks, U.S. stocks in particular, are overvalued. So the way we prepared our portfolios is that we are going into areas of the stock market and just other asset classes that tend to do well during a weakening dollar environment. And you know, some of that is holding stocks that are more, and we've been in this area for a long time, but continuing to hold stocks that are more in kind of consumer staples. We're also trying to increase some international and emerging market stocks, you know, just some defensive stocks in general, trying to hold on to the sectors that tend to do well, also trying to find stocks that are not overvalued, but also, you know, diversifying more by holding some gold, and then even having a bond portfolio that is diversified where that it can do well in both environments, both an inflationary environment, but also if the market takes a hit. And we'll get a little bit more into that in future updates. But these are the things that we're doing. These are the things that we're seeing. Hope this helps. Hope everyone stays healthy, and we'll see you soon. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.